Over the last 1 year, we have seen two extreme sides of stock market. During COVID, Sensex tanked almost 40% from the level of 42,000 to the lows of 26,000. And Nifty tanked from highs of 12,000 to lows of 7,500, creating huge panic among investors. And then some magic happened. Nifty and Sensex saw the rally of their lifetime, where Sensex rose from 26,000 to current level of 52,000, which is almost 100% jump. And Nifty rose from lows of 7,500 to current level of 15,300, which is also a 100% jump. All that happened within a span of 1 year. Now there are two sets of people in the market. First set of people are the newbies who are relatively new investors and entered into the stock market after the recent rally. They are highly optimistic people and have invested all their money into the stock market. Probably because they haven't seen any bear market or never witnessed stock market crash. Second set of people are veterans who have been into the market for a long time and understand the game of valuation. They know that the markets are overvalued and hence they have not invested into the market or completely exited from the market with a hope that the market will correct in the future and they will reinvest. Now the biggest question is, who is right? The first set of investors who think that this is the rally of their lifetime and the golden opportunity to create wealth from the stock market, or the second set of people who have completely exited from the market and they think that market is overvalued. Hello everyone, my name is Sahil and this is my Personal Finance Academy where I explain everything about money management in layman's language. This is the second episode of Let's Learn Investment, where we will discuss the hot topic of stock market. Is Indian stock market overvalued? If yes, then what should be the right strategy to balance the portfolio? So I have divided this topic in two parts. In the first part, we will discuss how to identify if the stock market is overvalued. Then we will discuss if it is overvalued, then why it is overvalued. In the second part, we will discuss as an investor what should be the right strategy to balance the portfolio when investing in the stock market. Alright, let's get started. Is the Indian stock market overvalued? This is a very common question these days. On one side, the entire country is still trying to recover from COVID pandemic and the GDP has shrunk 24% in Q1 and 7.5% in Q2 of FY21. But on the other side, the stock market in India has doubled from the lows in March 20. But why did the stock market behave in an opposite manner? Ideally, if the economy is falling, stock market should also fall, as stock market is eventually dependent upon the company's performance, which is dependent upon the economy. We will get back to this question of why the stock market behaved in an opposite manner. For now, let's first understand how the heck can we figure out if the stock market is overvalued or undervalued. Alright, there are two ways to identify the valuation of stock market. First way is via PE ratio. And second is via market cap to GDP ratio, or also known as Warren Buffett indicator. Let's first start with PE ratio. So PE ratio is the ratio of price per share to earning per share. Now what exactly is PE ratio and why it is important? We will not get into the details for now. I will create a separate video on that. For now, let's just understand that PE ratio is an important parameter to gauge the valuation of a company or entire stock market. Historically, the Nifty PE ratio ranges between 15 to 25. If it falls below 20, then you can say that stock market is undervalued. If it is between 20 to 25, then you can say that it is fairly valued. And if it crosses 25, then you can say that stock market is overvalued. For example, during 2008 financial meltdown, Nifty PE reached a peak of 28.29 just before the US housing bubble. And then after the stock market crash, Nifty PE fell down to PE of 10.68. When Nifty PE was at the peak of 28.29 in January 2008, Nifty was trading at a peak of 6,200. After the crash, Nifty fell down 60% to level of 2,600, and at that time Nifty PE touched 10.68. So clearly the market was overvalued before the crash when Nifty was at 28.29 and became undervalued after the crash when it touched 10.68. Although these are two extreme sides. Nifty PE would normally swing between 20 to 25, where you can say that it is fairly valued. In fact, if we take the recent example of COVID, Nifty PE was at the level of 29.9 in January 20 before the market crash. And after the market crash in March 20, Nifty PE touched a low of 17.15, making it undervalued. Do you know what is the current PE ratio of Nifty 50? Any guess? If you just search the PE ratio of Nifty 50, you will find that the current PE ratio of Nifty 50, which represent top 50 companies of India or almost 67% of total market cap of all listed company, is around 42. Yes, you heard me right. It's 42. That's insanely high. There is one more parameter to gauge the valuations. It is market cap to GDP ratio, or also known as Warren Buffett indicator. In simple language, this indicator suggests what is the valuation of stock market as compared to entire GDP. For India, the market cap to GDP is normally around 75%. It means the Indian stock market valuation is 75% of Indian GDP. And that's a fair valuation. However, recently it has touched the level of 100%. In fact, in the US, the market cap to GDP ratio is generally around 100%. However, currently this ratio has touched an insane level of 200%. So both PE ratio and Buffett indicator clearly suggest that the stock market is overvalued. Now let us understand the reason for such high valuation. There are mainly two reasons. First reason is that due to COVID, there was a sharp fall in earnings, which is the denominator of PE ratio. Now if the denominator would fall, obviously the PE ratio would increase. In the future, as the economy recovers, the earnings would increase and that would result in lowering down the PE ratio. Now, there is a second reason for such high PE. It is due to exorbitant rise in share prices. But the question is, why did the share price rise when the economy tanked? To understand this, you need to know the dynamics of the US market. So India is a big market for US investors as they invest a lot of money via FII or foreign institutional investment. Hence, Indian stock market movement depends a lot on foreign investment. Although today we also have domestic institutional investors that also impact the stock market movement. But there is still a lot of dependency on foreign investment. Of late, there is a significant inflow of FII money in the Indian stock market. This is mainly due to two reasons. First is due to huge amount of liquidity in the US market as the US Fed has printed trillions of US dollars. Second reason is that US Fed has reduced the interest rate significantly. Guys, this is very important. Interest rate is the key here. Governments uses interest rate to accelerate the economy or put a brake on it. For example, due to COVID, there were a lot of job losses. So the US Fed lowered the interest rate to as low as 0.25% so that businesses can borrow money at a cheaper rate and generate employment. Also, consumer can borrow money at lower rates and spend more. So both factors, including trillions of dollars of stimulus and lower interest rate, have created a lot of liquidity in the US. And this has resulted in a huge inflow of money in the Indian market and eventually resulted in increase of share prices in India. So I hope you got the reason why the share prices in India or Indian stock market is so high. It is because of a lot of inflow of foreign investment. Now the question is, will this rally continue, or if not, when will it end? To put it in a simple language, we can say that once the US investors or FII start withdrawing the money from Indian market, there will be a correction in the stock market. But when will the FII pull money? They will pull money when there will be an increase in interest rate from the US Fed. US Fed would eventually increase the interest rate when the inflation would increase due to high liquidity. When there will be an increase in interest rate, there will be a crunch of liquidity in the market. And this would result in US investors pulling back their money from the Indian market. So if we summarize the entire story, one of the major root cause of such high valuation in the Indian stock market is due to heavy inflow of foreign investment in the Indian market, and that is due to very high liquidity in the US market, which is again due to very low interest rate, and in the future due to high liquidity there would be an increase in inflation in the US. At that time, US Fed would have to increase the interest rate and that would trigger the correction in the stock market. The only problem is we don't know when will the US Fed increase the interest rate. It can happen tomorrow or in the next 1 month or in the next 1 year. So what should you do in this situation? Should you invest or should you exit? That takes us to the second part of this video, where as an investor, what should be the right strategy to balance the portfolio when investing in the stock market or mutual funds. Personally, I follow this strategy from Mr. Benjamin Graham. I'm not sure if you guys are aware, but he is none other than the guru of Mr. Warren Buffett. In 1949, Mr. Ben Graham wrote a classic book that became the foundation of value investing. The book is named The Intelligent Investor. In that book, he has mentioned the golden strategy of investment, which I personally follow. He says that nobody can time the stock market. So those new investors who think that the markets will never fall and they have invested all their money are wrong. When market rises to extreme levels, it will always correct in the future. And those who think that the market is overvalued and they have exited their entire investment are also wrong. It is because if there is a correction in the market, new investors would surely lose the money. But the investors who exited from the market would try to enter at some level, right? But the problem is, what should be the right level? Nifty at 12,000, 10,000, 8,000 or even below? In fact, during the market crash in March 20, when Nifty fell down to 7,500 during COVID, many investors did not invest their money, thinking that Nifty would touch 6,000. And when the market recovered, they regretted not investing. Ideally, everyone wants to invest when the market is at the bottom and exit when the market is at the peak. But it is impossible to time the market. Hence, it is very important to make a fine balance between equity and debt. Don't be too optimistic and don't be too pessimistic. The Intelligent Investor book suggests that you should make a balance between equity and debt in a fixed ratio and keep rebalancing periodically based on market situation. If the market is overvalued, like in the current case, then you should have more exposure in debt and lower exposure in equity. For example, you could have 25% exposure in equity and 75% in debt, or 50-50 in both equity and debt. And when the market becomes undervalued, like during the March 20 crash, you should increase your equity exposure to a maximum of 75%. So I have personally invested 50% of my money currently in equity and rest 50% is in debt. If the market becomes more overvalued, I would reduce my exposure in equity even further. And if there is a good correction and the market becomes fairly valued or undervalued, then I would increase my equity allocation. So this is the golden rule that I have learned from the book The Intelligent Investor. Now it is up to you to decide what is the best strategy for your investment. And tell me in the comment box how much allocation you have kept in equity. I hope this video would help you understand how to identify if the markets are overvalued and what is the reason for this overvaluation, and what should be the right strategy to balance the overall portfolio. In case you want to learn everything about stock market, mutual fund, insurance, tax planning in a structured manner, you can explore my video course. I will make a separate video on P/E ratio and explain how to check the valuation of each company before investing your money. Till then, take care.